Hey Trade Pros, welcome to another YouTube video. I hope everyone's doing well, and in today's video what we're going to be talking about is volume in options, open interest, and how to do some option selection, right, based on those two criteria. Now, open interest and volume is a very important tool when trading options and understanding how to use them properly. Now, there is a lot of confusion around them for the most part, and there is a little difficulty around them and how to use them, but what we're going to do today is explain to you guys from a beginner standpoint on how you can use open interest and volume, what they mean to effectively select some options to trade. So I hope everyone's doing well, and welcome to our channel. If you guys are new, check us out, smash that subscribe button, hit that like button, drop a comment down below if you have any suggestions or you want to hear anything specific from us. Now let's dive into this intro and we'll go right to the video. So in front of me, you guys can see that we do have a options chain here. This is PEP, so Pepsi, and what we're going to do today is compare liquid options chains versus not so liquid options chains. Now, PEP is what we consider a slightly more illiquid options chain, and when you see the options chain, now this is Interactive Brokers, you could look at potentially some kind of different platform, right? There's a lot of them out there, TD Ameritrade and so on, but over here on the screen, you guys can see that we have volume in one of the categories and we have open interest here in the other category. Now, volume and open interest, right, you can see that there are pretty big differences as you go around the chain. And these expire this coming Friday, right? They expire this week. Now, if we go to a different option here, the monthlies, you can see they may be a little more populated in terms of open interest and volume. Now, if we compare this to a slightly more liquid name like Tesla, for example, or if you go with the SPY, you're going to see that there is going to be a big difference in the open interest and volume population of the actual options chain. Now, before we dive too much into this chain, we got to break down what volume and open interest are. Now, they're slightly confusing, but they go together pretty well. Now, the open interest of an options contract is the contract open, right? It's going to be any contract, right, that it is open, right? That means that whether it's bought or sold, if the contract is not expired, right, or hasn't been closed out, has not been exercised, then it's going to remain open. So the way that option open interest decreases is that a contract closes, right? It's exercised or it's going to be expired. So by the end of this week, right, the open interest for these November 26th Tesla calls or puts is going to go down to zero, right? Because they are going to expire. Some are going to be exercised. Now, on the other hand, volume here, right? Volume in the options contract is the exchange, right, of buyers and sellers, which could be this contract times, I don't know, like 100 today, right? So if we go with the 1175 calls here on Tesla, if the open interest remains the same, but they decide to exchange hands thousands of times between buyers and sellers, the volume is going to go up. So the volume is going to be the actual trades between buyers and sellers of the contract that exchange hands. Because you just noticed live that the options volume just increased while the open interest stayed the same, right? So let's see, if the volume increases again right in front of us, then we're going to see if the open interest stays the same. And if the open interest stays the same, that means that the contracts were just exchanging hands rather than new contracts being born or closed, right? So one more thing about volume is that the volume actually only goes up, right? You can see the volume just went up by a few contracts. Open interest stayed the same. Volume can only go up. You can't decrease in volume. So the volume and the open interest together will bring forth the liquidity of the contract, meaning that you're going to see a very liquid contract have very heavy volume and open interest. So let's break that down. What does that mean? Right now, we just went up about like 20 contracts in volume here. Open interest stayed the same. So you're seeing live how open interest stays consistent while volume increases, right? So that means that volume will regardlessly increase if there are trades back and forth between buyers and sellers for this contract. So if I am a buyer, right, and I buy this contract, that means that I'm going to exchange hands with a seller. So that means I'm going to contribute to the volume itself. Now, if I open a contract, right? If I open a contract or close a contract, by closing a contract, I mean if I exercise a contract, then I'm going to contribute to the actual change of the open interest. So looking at this, typically what we see is liquidity in the volume and the open interest. That means that the open interest is likely the interest, right, as obvious as that sounds, for a contract. So the higher the open interest, right, that means that there's more interest in the actual contract. Now, the higher the volume means that that contract is getting traded more aggressively, right? So both of them do contribute to the liquidity of a contract. You can see the 1200s here, very heavy on the open interest and extremely heavy on the volume side. Now, round numbers like these, right, like 1200s, 1000, you'll see it's very deep in the money. But if we go to 1000 here, you'll see pretty heavy open interest. But since it's so in the money, it's probably not that well traded. But if you go to 1300 here, right, very high open interest and volume compared to everything around it. Now, if we break it down liquidity by liquidity, that means that if you typically have high, let's say you have low volume and low open interest, right? Let's start from there. That means that the contract is fairly illiquid, right? There's not that much liquidity in that contract, and it's maybe something that you should not be trading. So compared to Tesla, if we go something like PEP, right, we can see that there are a lot of contracts that maybe shouldn't be traded, right, because of the liquidity. So you can see right here that this guy has 172.50 these calls, right? 128 open interest, and the volume's 20. So very low traded on the open interest and volume side. Now keep in mind that these could be sellers. They're not necessarily buyers. So someone could be selling these contracts, right? They could be selling these contracts and taking home the premium. Now that doesn't mean that they're buyers, and we're going to see this price rocket, right? The expectation that this contract expires at zero. Now, if we compare it to the SPY, for example, we saw one liquid contract in Tesla. Now we're going to compare it to the SPY and see the liquidity on the SPY. You can see this is the SPY movement today. SPY has moved up and down very erratically, really good moves. And even the 0 days to expire that expired today, heavy open interest and heavy volume. You can see these guys 275,000, 103,000. You can see it what the open interest is. So if the open interest and the volume is high, then there's going to be high liquidity, right? If it's low liquidity, there's going to be a wider spread between the options bid and ask. If there's high liquidity, we're going to see a very tight spread. So that means that we can get in and out of these positions fairly easily. Now, if we have low open interest and high volume, the contract is fairly liquid and has the potential to become illiquid very quickly because there's not that many hands trading the contract. Now, if you have high open interest and low volume, right, that means that the contract might be fairly illiquid, but can become liquid very quickly, right? So to reiterate, low open interest and high volume, right, there's liquidity in the contract, but it can become fairly liquid quickly. And then the opposite, if we have high open interest and low volume, it's technically a little more illiquid, but can become very liquid very quickly. So we want to watch out for those. Now, I do like when the volume is very heavy with fairly heavy open interest, right? I don't mean if we have like 100 open interest here and the volume's like 200,000. I mean something like this, right? 15,000 open contracts, about 15,000 open contracts, but they've exchanged hands 104,000 times, right? Now this is heavy. Open interest above like 1,000 usually is fairly good. Ideally, we see open interest above a few thousand, which promotes a little more of that liquidity. And then the higher the volume that comes in becomes much more attractive for that contract, right, to be able to trade that contract. Now, there are a few other things to consider because, again, you can see that the pricing of these contracts is very low. Now, these do expire today in about 10 minutes or so. So that means that maybe we'd like to consider the following expiration and see which contracts are fairly liquid here. So you can see that all of the volume is heavier than the open interest for these out of the monies. So that means that, and based on our option selection, we could go slightly out the money in the first like 2 or 3 that are at the money / out the money and find a potential trade there because you can see these are all very, very liquid. Right now, the open interest is very high, and the volume is extremely high here. So selecting these is going to provide us liquidity, and it's going to provide us a good potential trade, right? If we're net long, it doesn't mean that we can just get long right off of this because it has very good liquidity. We need to see what the overall market is doing, and right now that we're dumping here, right, the SPY is selling off very aggressively. Maybe we don't want to be in these calls, right? Maybe we might look for some puts. So it's important to use that in your option selection. And if you notice that the open interest is starting to increase, right, day in and day out, maybe for some options that are further outdated, right? Maybe these December 17th. If you start to notice, if you see the options chain for out the money start to increase in the open interest, and with that the volume gets heavier and heavier, right? If you notice, for example, let's say the 475s, right? The open interest is 28,000, but the volume is only 11,000. That means they haven't been traded that much yet. But there's a lot of interest in these. Now, there's a ton of interest in these 476s. Doesn't mean that they're all bought, and we're going to get to that price by December 17th, but very, very interesting here. You got 60.5K, heavy on the open interest side. And you want to notice, does volume start to increase on these? Are we starting to see maybe more interest in trading these? So if we start to see increase in volume with this already heavy open interest, maybe that becomes an option to consider, right? The option selection process in that. So you always want to remember, you want to see open interest at least 1,000, maybe if not more, and make sure that the volume is rising with these options. So if I go to Pepsi here, right, this open interest right here is 2.7K, but the volume is very thin, and the price is just abysmal. So it's maybe not something that I want to consider. Now, these 165s, they don't look that bad depending on what the actual price is doing. Now, if we go to something like Roku, they don't have very liquid options either. However, right, you can see, okay, here, the 240s, right? Very nice open interest, and the volume's pretty heavy. So maybe this liquid option is something to consider. So remember, there is a difference between the open interest and the volume, right? They both play a role in your option selection. And if you understand these fairly well, you can get a good grasp of which options to select, right? Which options to watch as a beginner, right? Which options are seeing more increase in the interest and volume, so you can decide on a position for maybe a longer term swing or even a day trade. So with that being said, I hope you guys enjoyed this video and learned a lot about open interest and volume and how we can use that in our option selection. So if you enjoyed the video, I want you guys to drop a thumbs up, drop a comment down below, and let us know what you'd like to see next. Was this video helpful? And can you use it in your upcoming trading? So thank you so much, guys, and I'll see you guys next time.